Barry and David, neither of you have been particularly bullish going into the earnings season, but Barry, does any of the results we've gotten so far ratify your point of view?
It just started. We're fully $6 below the consensus at 159 in earnings this year. The street's at 165. You know, the tech earnings largely fall short in our model, particularly in the middle quarters of this year. And then we're looking for disappointment on the energy side, but it's mostly tech. At a little over 18 times trailing and a little over 17 times forward, the market is priced pretty much to perfection. And that's just a function of very low real rates and rates below neutral, which is extraordinary.
David, I mean, you've kept this recession call going, and yet the stock market is trading 1% from a record high, and bond yields have really pushed away from those sort of seemingly scary low levels. So is the market telling us the opposite is happening?
Well, I think that what the market has told you this year is that a lot of the event risk that was causing the meltdown in the fourth quarter have subsided. So not so much about the economy, but you know, Brexit looks like that a hard exit has been kicked down the road. A risk that the Fed was going to make a big policy mistake, well, that's been alleviated. And remember that in the last few months of 2018, Donald Trump was calling himself the tariff man, and now apparently we're just weeks away from a trade deal with China. So actually, we've just basically taken event risk off the table for the time being. You know, if this was an earnings-driven rally in the stock market, I would say, yes, Sarah, absolutely. You know, I'm completely wrong on this call. Earnings are doing fantastic. But it's been purely and solely a multiple-driven story, and actually we're now pressing against 17 on forward multiples, which is where we were back in September, and you knew what to do back then at these levels of valuation. So I think, look, this is a momentum sentiment rally. You know, you can say to me, well, the bond yields are off their lowest levels of a few weeks ago, but then again, you know, we're still considerably below where we were last fall. So has the market action dictated my view on the economy? The answer is no. No more than when we hit the highs in October of 2007, when I was getting the same question as to whether the S&P 500 was kicking me off my recession call back then. Well, lo and behold, 2 months later, we're actually in a recession. So, you know, I do my own work on the economic outlook, and the markets will do what they're going to do. But the answer is no. I haven't changed my call.
Yeah, I mean, we're interested in both, but part of what we're interested in, Barry, is how the market is reacting. You know, earlier in the year, there'd been this narrative that managers had been burned in December, had not yet been able to lever up again. There was a bit of a chase going on. Does that mean that if we do hit these new highs, that's naturally a ceiling here?
Well, when you think about it, the market failed to clear. It was starting to clear in December, and the Fed pushed that back. The Fed got chicken. And as they retreated, the market bounced back, as Dave said, on a PE basis. But we do see disappointing earnings this year, and we think it'll manifest in the middle quarters particularly. We're going to be looking at the fact that we have an extraordinary amount of market clearing that's never really occurred. And when you think about it, we live in a world every 2.5 years with huge dollops of free money and directed lending. All we're doing is going on and on like a drug with less and less effects. We live in a centrally planned market with central banks acting like politburos. And as strategists, we have to interpret what they're saying. Right now, the Fed is on hold, and that's why the market's up. It's really nothing but that.